Hey there, and welcome to your deep dive into the intelligent investor. We're going to unlock some serious wisdom here, folks. Talk about a legend in the investing world today. It's Benjamin Graham.
And you know what's amazing? His insights are every bit as relevant today as they were decades ago. It's incredible.
I know, right? This is a book written before the internet, before index funds even existed. But you picked out some really interesting sections from it. You ready to get into it?
Absolutely. Let's unravel what stood out to you.
All right, perfect. First up, you highlighted Graham's definition of an intelligent investor. And let me tell you, it might not be what you expect.
Not at all. It's not about having some genius IQ, we're trying to find a crystal ball.
Exactly. He's talking about temperament, discipline, keeping a cool head when the market's doing its best to, totally freak you out.
Yeah. It's about mastering your emotions, not letting them master you.
So true. Think about a time you almost panic sold an investment. Like, oh no, everything's going down. That was good old Mr. Market whispering in your ear.
Trying to get you to make a move.
Trying to get you to act all irrational.
Exactly. Graham knew that markets are driven by fear and greed. And to succeed, you've got to master those emotions.
Speaking of Mr. Market, you flagged that section where he compares investing to a unique kind of casino. What was it about that analogy that stood out?
Well, think about it. Most people, when they think about the stock market, they think the house always wins, right?
Hey, that's the saying.
But Graham flips that idea on its head. He says by following the principles of intelligent investing, by really focusing on a company's intrinsic value, well, you can tilt the odds in your favor.
So instead of trying to outsmart the roulette wheel, you're playing a different game altogether.
Exactly. One where patience, discipline, and really understanding value, those are your winning hands.
Love it. It's about recognizing that the market price, that ticker tape going across the screen, it doesn't always reflect what a company's truly worth.
It's two very different things.
Okay, now you also highlighted a passage about growth stocks. These are the companies that, everyone expects to just skyrocket in value. What made you stop there?
It's tempting, right? Those obvious prospects, as Graham calls them. But they come with a whole lot of risk.
Well, yeah. So easy to get caught up in the hype. Everyone wants to find the next big thing.
Exactly. And, it reminds me a lot of the dot-com bubble. Back then, everybody and their brother thought internet companies were just like invincible growth machines.
It was wild.
People poured money into companies with no profits, sometimes not even revenue, and then
Boom.
boom.
And Graham saw this pattern again and again throughout history. I think he even used the example of Texas Instruments, if I remember correctly.
Perfect example.
Yeah.
Early 1960s, their stock price was going through the roof. But, what did Graham notice? The price was outpacing their actual profits by a huge margin, and sure enough,
What happened?
crashed right back down to earth.
Ouch. It's a good reminder, though, that past performance is never a guarantee of future returns.
Ever.
Okay, but how do we apply that skepticism to today's hot stocks? I mean, everything's tech, right? How do we know what's the real deal and what's just hype?
That's where Graham's emphasis on that margin of safety comes in, but maybe we can save that for a little bit later first.
You're teasing us. All right, well, let's talk about another highlight you marked. This is where Graham suggests that investors would be better off if their stocks had no market quotation.
Wild.
That seems a little counterintuitive, wouldn't you say?
It does, right. But it all goes back to tuning out that noise. Tuning out Mr. Market.
Ah, okay.
If you were never bombarded with those daily price updates, up, down, red, green.
Oh, I'd be so much more relaxed.
Right.
It's like sometimes I just need to log out of my brokerage account for a week.
You'd be less tempted to react emotionally. You could just focus on what really matters, the underlying value of the companies that you own.
It's like, remember, you're a part owner of this business.
Yeah.
You're not just, playing some kind of video game with your portfolio and hitting refresh every 2 seconds. Okay, this next one, I gotta say, really caught my eye.
Oh, yeah.
You flagged a footnote in Chapter 12 about a company's explanation for its special items.
Oh, the footnotes.
Who flags a footnote? You must have seen something juicy in there.
Well, sometimes, the footnotes are where the real story is.
Okay.
But this is a perfect example of why you have got to scrutinize a company's financial reporting. Don't just skim the surface.
So what were they trying to slip past investors?
So they were trying to explain away all these kind of random expenses by lumping them together as like a one-time special item. Like, oh, we sold off this tiny, baby clothes division of our company.
Right.
We shut down the ski boot operation.
It's like, that doesn't really fit with your core business.
Exactly. Stuff that just didn't make sense.
Right.
And Graham saw right through it. He knew they were trying to make the financials look prettier than they really were.
Classic.
It's a warning to investors, right? Like, pay attention.
Yeah.
Read between the lines, even in those boring footnotes, because that's sometimes where they're hiding, how they're really allocating capital.
It's like those terms and conditions that nobody reads.
Exactly.
Sometimes the most important details are hidden right there in plain sight.
Absolutely.
All right, let's talk about these super investors. We've got to talk about the super investors in the appendix. You really dug into that section, and I want to hear all about it. What stood out to you?
This is the section that always gets me fired up because it shows that Graham's principles actually work. Not just in theory, but in the real world. These investors used his value investing approach to get incredible results. Right?
Absolutely.
Yeah.
But they weren't all making the same trades.
Okay.
It's not like they had some secret club where they were like,
insider trading.
Yeah. Here are the hot stocks. Buy this, sell this.
Right. No, not at all. What's so fascinating is they each had their own style, their own approach to finding these undervalued companies. But the common thread was that Graham philosophy,
Yeah.
discipline, patience, focus on value.
They had the foundation.
And
they built their own houses on top of it. You were particularly interested in the story about the Washington Post company. What was it about that example that, sparked your curiosity?
Yeah. Well, I think it's a great example of how even large, well-known companies can be mispriced by the market. So this is the early 1970s, and the Washington Post company, they owned the newspaper, Newsweek magazine, a bunch of TV stations.
Right, a media empire.
They're valued at something like $80 million.
You're kidding.
I know.
$80 million.
It's mind-boggling.
You're telling me a media empire was worth, what some people spend on a private jet?
I know. As Graham pointed out, you could have sold off the individual assets for at least $400 million, probably way more.
So the market was massively undervaluing this company just because it wasn't the hot new thing at the time.
Exactly. And that's the opportunity for the intelligent investor.
Right.
It's having the courage to buy when everyone else is selling, to see that value where others don't.
It takes a certain kind of discipline to not get swept up in all of that and to just stick to your guns.
Yeah, you can't follow the herd.
Speaking of sticking to your guns, we've talked a lot about Graham's, big picture philosophy, but you also highlighted some sections about some of the nitty gritty, how do you actually do this stuff? Things like margin of safety.
Yes, margin of safety.
A lot of investors struggle with that one, myself included.
It's one of the most important concepts in the book.
Oh, for sure, but it can be hard. How do you put a number on safety?
Think of it like this. Imagine you're, at the store and you see a jacket, right? And you love this jacket. It's normally $200, but today it's 50% off.
Okay, I'm listening. I love a good sale.
So you're getting that jacket for $100 off.
Oh.
That right there, that's your margin of safety.
Okay, I see. But how does that, translate to investing? Give me the investing version.
So you're only going to buy a stock when its price is, significantly lower than what you think it's actually worth. That discount, that difference, that's your margin of safety. It protects you if, your analysis is a little off. Or if the market just, tanks all of a sudden.
So it's like having a cushion.
Exactly, a cushion for error. Because none of us can predict the future.
If I could predict the future, I wouldn't be sitting here.
Exactly.
Yeah.
But that margin of safety, that helps you sleep at night knowing even if you're wrong, you're not going to be, completely wiped out.
It's that sleep at night factor. I'm all about that sleep at night factor. Okay, but we can't talk about margin of safety without talking about intrinsic value, right? You highlighted this section too. You knew we were going to be talking about this stuff.
It's all connected.
But figuring out a company's intrinsic value, it feels kind of impossible. Where do you even begin?
Yeah, it can feel daunting, that's for sure. But Graham gives us some tools. He emphasizes looking at those financials, really digging into those numbers, but then also understanding the company's long-term, prospects.
So it's not just about the numbers themselves. It's like the story behind the numbers.
The story, exactly.
Okay.
What are their competitive advantages? How sustainable are those profits? What does their future growth look like? These are all the things that feed into intrinsic value.
So you have to see beyond the hype and really understand the business.
Yeah.
Like, are these people actually making something people want?
Are they solving a problem?
Exactly.
What problem are they solving?
Okay, you highlighted a part here about shareholders and management. I'm curious, what resonated with you about that?
Oh, this is huge.
Yeah.
Because for me, when I'm looking at a company, it's like, who are these people running the show? Are they ethical? Do they seem competent? If I was going to go to business with these people, would I trust them?
Yeah. Would you let them, like, borrow your car?
Exactly.
It's true.
And Graham, I think, was so far ahead of his time on this. He really understood that a company is only as good as the people running it.
100%.
Investors, don't just hand over your money. Do your due diligence.
Yeah, don't be afraid to be like, hey, hold on a second. Who are you?
Exactly. Look for those red flags, like
Yeah.
crazy executive compensation packages when the company is not doing well.
Ooh, yeah.
Or, lack of transparency in those financial reports. Those are signs that maybe management doesn't have your best interest at heart.
And it's amazing how much those things get overlooked. Like,
Yeah.
oh, yeah, just whatever, give me the stock. No.
Read those reports.
Okay, last couple things from your notes. You marked some sections about diversification and patience.
Oh, the big ones.
These are concepts I think a lot of investors struggle with, myself included.
For sure.
So diversification, why was that so important to Graham?
Well, think about it this way. Would you put all your eggs in one basket, especially if, that basket's a little prone to some turbulence?
Okay, terrible analogy, but I get what you're saying.
Right. Don't put all your money in one stock, no matter how promising it seems.
No matter how much you love it.
Exactly. Because Graham was all about spreading that risk. And not just across companies, but different industries, different asset classes.
Yeah.
You want to be prepared so that if one area of a market takes a hit, your whole portfolio isn't,
Go down the tubes.
Exactly.
Build that portfolio that can weather a storm.
Yeah.
You don't want to just be sailing smoothly when it's nice and calm. You want to be able to weather those storms.
You got to be ready.
Exactly. And that leads us perfectly into this other point, patience.
Mm.
Graham really believed that building wealth, this is a long game.
It is. It's a marathon, not a sprint.
Oh, tell me about it.
Yeah.
We live in a world of instant gratification. I want to see those returns, like yesterday.
Right. But think about it. Even the most successful investors in the world, they'll tell you that some of their best investments took years to really pay off.
Years.
They rode out the dips, they ignored the noise, they let their investments compound over time.
There's that word again. Compound interest.
It's magic.
It's like the snowball effect for your money, but it only works if you give it time to roll.
Exactly. And that requires patience. It requires that discipline, that long-term perspective. Trust the process even when things get bumpy.
It's all about trusting the process and remembering that you're investing in businesses, not just playing a day trading game on your phone.
Yeah.
Okay, we have covered so much ground here today, from Mr. Market's mood swings to those sneaky footnotes. As we wrap up this deep dive into the intelligent investor, what's the one thing you really want our listeners to walk away with today?
It's more than just picking stocks, right?
Right.
It's about cultivating that mindset of discipline, patience, being a lifelong learner. Always be curious, always be learning.
Yeah. Stay curious. It's about being in it for the long game, not the quick buck.
Absolutely.
Always remembering you're investing in businesses, you're becoming a part owner of that business, not just buying a ticker symbol on a screen.
Well said.
This is awesome. I always learned so much from you. Thank you for doing this deep dive with me today.
My pleasure. Anytime.
And all of our listeners out there, keep learning, keep growing, and as always, happy investing.